Interest rates. Two pretty short words, but in the time that it takes my brain to process them, I get bored as shit. Somewhere deep inside the recesses of my skull, I know that interest rates are important for me to understand. Yet when it comes to discerning these enigmatic semantics, my usual gushing river of curiosity runs nothing short of bone dry. And yet society is abuzz over these interesting rates, their impact on our lives, and the money gods that apparently wield power over them. So even though I have no idea what's good with these thingalings, you can bet your bottom dollar I'm about to find out. Now, kids, the world of economics is a vast cosmos, swirling with different forces that shape the way we exchange goods, services, and bribes. One of the most powerful tools we use to shape these forces is interest rates. Isn't that right, University of Lynchburg professor Gerald Prante?
Well, interest rates are basically the cost of borrowing money, and the reward for lending money, as well as a compensation for the risk you take when you lend somebody money.
Thanks, Gerald. Now, there are all kinds of different interest rates depending on what you're borrowing, for how long, and from who. But it turns out there is, in fact, one daddy interest rate to rule them all: the federal funds rate. And this is the rate everyone's interested in.
Get ready for lower interest rates.
First interest rate cut in about 4 years.
Cutting interest rates.
They reduced interest rates.
Raising rates.
Interest rates. What if the Fed lowers interest rates in September? What does that even mean? And what does it mean for you?
The Fed funds rate is the target interest rate that commercial banks use to borrow and lend reserves to each other overnight. Sounds important. But where does this rate come from? Well, look no further than the Federal Reserve, the central bank of the United States and the largest central bank in the world, thank you very much. Led by Salt and Pepper Slender King Jerome Powell, the Federal Reserve's two big jobs are to maximize employment and control inflation, or keep the prices of stuff stable. And one of the main tools that the Fed has to achieve these dual mandate goals is raising or lowering the target Fed funds rate. Then after that, it must be, I don't know, some sort of ripple effect from there?
It's sort of like a ripple effect from there.
Fuck, I'm good.
They set the baseline interest rate. That goes through to how banks lend to each other. That goes through to how banks lend to individual people and businesses, et cetera, et cetera. And that goes through to basically every interest rate in the economy.
To toss some examples at your head top, if the Fed funds rate went up, that would make borrowing money more expensive across the economy. Therefore, the cost of things like home loans, credit cards, auto loans, and student loans would, in theory, go up as well. Now, you might say, hold up, Dan. Sounds like these Yanks are trying to hurt the economy. But the Fed is willing to harm the economy in the short term to do a good thing for the economy in the long term: stop inflation. And this is all about balance. During good times, the Fed raises rates to encourage people to spend less, whereas during bad times, the Fed lowers rates to encourage people to spend more. The goal here is to make sure that the economy doesn't spiral away into hyperinflation or fall off into a recession. Pretty big responsibility.
They have an extremely powerful tool and something that is necessary for economic prosperity. Good monetary policy management is a baseline necessity if you want to have economic prosperity. And there's a reason why countries that we think of as really bad economies also tend to have really bad central banks.
And even though we think about our whole milk U.S. economy as being pretty stable, we had a pretty big scare not too long ago.
When things aren't stable, people care a lot about this. Everyone was just terrified of what was going to happen to the economy at the outset of 2020.
Jeanna Smialek is an author and reporter for the New York Times covering the Federal Reserve.
The Fed was part of the equation of coming in and keeping things from falling to pieces completely. And then when the inflation took off, obviously the Fed is part of that equation too.
Going back to the Fed's wet dream of a balanced economy, they like to keep inflation at a steady 2%. But after COVID, inflation skyrocketed to a whopping 10%. I mean, I'll never forget seeing those prices when I was shopping at Kroger back in Q4 of 2021, doing my quarterly bulk relish pickup. It's a skin thing. Don't worry about it. The Fed responded to this inflation spike by aggressively hiking interest rates, which they've been doing until a few weeks ago when they made the first in a series of anticipated major cuts, hopefully lowering inflation without causing a recession. Known in the biz as a soft landing.
Soft landing is just a way to refer to a situation where the Fed manages to bring inflation down without causing the unemployment rate to spike and the economy to fall into a recession. So it's basically exactly what it sounds like. It's landing the plane without a really bumpy runway ride at the end of it.
Now, pulling off that Captain Sully-style soft landing would be a big old feather in Jerome Powell's cap. It's a notoriously difficult maneuver, one that has rarely been achieved in the annals of economic history. Though I did try it once in the backseat of my parents' car in high school, and let me tell you, not a single one of us landed. But even though adjusting interest rates is the main way that the Fed can achieve that soft landing, interest rates aren't their only tool to manage a feisty economy.
This is very specific to one state of the world, very much about the Fed's emergency powers. So in times of crisis, the Fed has an ability to go out and really sort of backstop a wide variety of markets to keep them from crashing down. And those powers have really been sort of experimented with and expanded over time.
One example of the Fed's surprisingly wide-ranging power comes during their response to the 2008 financial crisis, when Fed boss Ben Bernanke solo-approved a $600 billion program to help out markets who got run over by the struggle bus. And with tools like these that can be used to aggressively change our economy in the short term, the Fed is potentially an extremely useful political weapon. I mean, if you're a politician able to control interest rates, you can imagine how helpful that would be to win an election. And that's why the Fed is structured to insulate it from the political sphere, so that it can make decisions in the country's economic interests, not in a political party's interests.
They don't want to be influenced by the president or Congress. It's supposed to be that independence. It's supposed to be paramount to the Federal Reserve. I would say similar to something like the Supreme Court.
Fed officials aren't elected, but appointed by the president and confirmed by the Senate. And once members of the Fed are in place, neither the White House nor Congress has any oversight about how they go about stabilizing the economy.
The Fed is kind of this quasi-democratic institution.
Well, Professor, quasi is my favorite form of democracy, and I'm glad that we have that system operating in this country.
Exactly.
And if anybody, I mean anybody, tries to introduce some slippery political motives into our glorious central bank, well, a little place I like to call the Senate starts getting frisky. We saw this in action throughout the Trump presidency when the big Don tried to appoint a bunch of political operators to the Fed who were then straight up rejected by the Senate, including dead pizza mogul Herman Cain. And I want to be crystal clear on this point. Herman Cain was alive when Trump nominated him. Herman Cain is dead now. Now, Trump is still saying that if elected, he wants the White House to have a say on the Fed's policy decisions. But even though Trump's central banking allies have said that's not going to happen, I do empathize with the Donald's desire to want a piece of this magical mechanism that can control the chaotic economic cosmos and deliver us a stable economy. I mean, it's a tantalizing idea, and one that I often think about in moments of climax. But is this idea that controlling interest rates is tantamount to controlling our economic future too good to be true? When I asked Gerald to speculate on whether or not the Fed's current interest rate cuts would lead us to this mythical soft landing, he did make an interesting point about the inherent chaos of the system that we're talking about.
I would say by the middle of next year, we'll be able to determine if inflation really gets under control and we're not in a recession, then we will probably have had a soft land. Of course, there's a lot of other things that could go wrong. There's risks out there. There's things that go right, too, but there are a lot of things that could go bad. You got potential war breaking out. You've got an election coming up, which could throw all sorts of, who knows what's going to happen with that. And so you've got these other factors out there.
Indeed, all those factors do be out here. It's a scary place, the economic cosmos, teeming with threats like unemployment, inflation, recession, and depression. Like it or not, though, we all live here. And the folks at the Fed try to balance it all out, so amidst the chaos, we have equilibrium. But even though adjusting interest rates turns out to be a mighty powerful tool in creating that balance, well, there's always a chance that you'll get hit in the face with a flying asteroid anyway. And we can get an asteroid on... Yeah, we can do that? Like a flying asteroid? Okay, great. For good work, I'm Dan Toomey.